Hey folks, Dan Frio here with your real estate update for January 11th, 2024. I got it right, folks. So in today's video, we're going to go over the inflation numbers that just came out, and I'm going to precurse you on this one. I don't know. And you'll understand here in a minute when I come back and say, I don't know, because I'm always a proponent. If you don't really know the answer, it's okay to just say, I don't know, instead of just making up stuff. If you're a little confused, you'll get it by the end of this video. So let's get over to it without further ado. Why are you here? You're trying to figure out what in the heck's going on with mortgage rates and what's going on in real estate. So that's what we're here for. So what we're seeing right through here are the top 6 programs people use when they're buying their first house. These are not my rates. These are no individual bank's rates. What this is Mortgage News Daily right up through there. They survey lenders all over the country every day, and they ask them these 5 questions. You had somebody buying a house, it was a single family home, it was going to be their first home, and it was going to be their primary home, where they're going to live. Okay, those 3 things. So you might be like, okay, that's me, that's my rate. Well, there's a little bit more to it. These people have a 740 credit score and they're putting down 20%. That's probably not you. So to figure out what you would qualify for, or can you even qualify in today's market, I'm going to give you all my information at the end of this video. So without further ado, let's get over to it. So these, like I said, these are the top 6 programs that people use when they're buying their first house. Rates are basically just flat. One day they're up 0.02, the next day they're down 0.02. So they're basically flat, which we like it. But we had some big news coming in today that the Federal Reserve monitors, and that's on the inflation front. So I want to go over these numbers with you and how this is a little confusing. And you'll understand this here in a second. The inflation front that the Federal Reserve monitors on the consumer side of the equation is called the CPI, the Consumer Price Index. That number came in today. The previous number was 0.3. Number was supposed to come in at 0.3. It came in at 0.3. Okay, that's right on the button. Now, here's where we have a little bit of a disconnect. The previous year-over-year number, that's what you're seeing right through here. So you have core, year-over-year, and then month-over-month. What core is they basically pull out food and energy because it is so volatile. Look at gas prices. Gas prices 2 months ago were about $4 a gallon. Right now they're $2.99 a gallon. So huge drop. So that's why they extract this data out. So when we look further in the CPI year over year, last reading came in at 3.1. We're looking to get into the 2s. Well, they thought it would uptick. Economists forecasted it would be up 3.2. It actually came in at 3.4, much higher than expected. So then the first thing I'm thinking is, okay, inflation's coming in hotter than expected. So the Federal Reserve, they might not, reduce rates or pivot. So that's the biggest concern, okay? And then we also have jobless claims. Jobless claims, remember the Federal Reserve says they want more and more people not working, okay? So the last reading was 203. They expected the jobless claims to go up to 210, meaning more people lose their job. It actually went down. We have more people working, and we have inflation going up, which means the Federal Reserve most likely is going to keep rates where they are. They're not going to cut. So I'm going to show you the bond market right now, just to give you a little precursor on this. If we look at the bond market's kind of loving the data. Okay, so let's get over to, and I'll get to that in a second. Let's get over to the nitty gritty on the CPI numbers. Consumer prices rose 0.3% in December, higher than expected, pushing the annual rate to 3.4. But the big thing here is housing. Much of the increase came due to rising shelter costs. Now, if you watched yesterday's video, which I'll put the link right up through here, I went over housing, and this was kind of a conundrum that we got this data today. I was saying a lot of the data that the Federal Reserve monitors is lagging. I'm not saying it's bad. I'm just saying it's lagging. It's months behind the curve. If you really use today's shelter numbers, the shelter numbers are way down than what the numbers the Federal Reserve is looking at. So that might be one reason why the market isn't reacting as harshly as I thought it would be. Next thing is we have wages to inflation posted a 0.2 gain on the month while rising a modest 0.8% year over year. So the good news in the market right now is people are making less money. Now, I'm not trying to be the bad guy here, the Grinch. This is what the Federal Reserve wants. They want more people not working. Okay, they want people not making as much money, and they also want people not spending as much. That's going to cure inflation. That's their goal. Okay, so what we're seeing today is basically people are still spending, but the tough part about that is they've depleted their cash, or a lot of the cash that they've had. They're maxing out credit cards because consumer debt right now is at an all-time high. And a lot of people are now tapping into the equity of their homes and also retirement accounts. That's a scary proposition. So without further ado, let's get over to the Chicago Mercantile Exchange. I want to share some data there with you too. So I already precursed this, or already set this one up. So the CME we're going to look at right now is when the Federal Reserve meets the next time, what's the probability that they're either going to keep rates the same, they're going to raise rates, or they're going to reduce rates. So let's get over to this. We go to the CME FedWatch tool. If you go down through here, this is basically telling us what's the likelihood Federal Reserve will change the federal target rate at the next meeting. So the federal funds target rate right now, or the rate, is 5.25 to 5.5. Okay, so that's what I want you guys to understand right now. So if you look through here, you're going to see this. We are at 5.25 right here. Hold on, let me see if I can get that out of the way. We're at 5.25. Let me get my head out of the way. This might make it just a little bit simpler. Right through here, we are at right through this range right here. We're at 5.25 to 5.5. So the meeting that they're going to have at the 31st of January, there's basically a 97%. There's almost a 100% chance they're not going to do anything. They're not going to raise rates. They're not going to reduce rates. Here's the pivotal point. Now what people are saying, or the markets are telling us, they're going to start reducing rates in the March meeting. Is it going to happen? I don't know. Okay, again, it's one of those things I just don't know. It's going to happen, but when? It might be in March or it might be in May. But that's when we're going to, my view is they're going to start to pivot and reduce rates. But again, it's going to be completely data dependent. What you're seeing here is in January, they're expected to keep the rates the same. Again, as you can see, the federal funds rate is right here, 5.25 to 5.5. So there's a 97% probability they're not going to do anything. And now here's where you start seeing it. 63% probability that they're going to reduce rates down to 5 to 5.25. And then over a 50% chance in May, they're going to reduce it once again down to 4.75 to 5%. So that's the chart that we're watching right now meticulously. So in this data, if you go over to basically our bond market right here, what I use on a daily basis. So this is MBS Live. This is what I use on a daily basis. Why I really want to keep a beat in on what's going on with the bond market. Why the bond market? Well, the bond market, especially this one right here, is a mortgage bond. The yield on this mortgage bond is the biggest component of your interest rate or your mortgage rate. Banks don't make up or just create what the mortgage rate's going to be. The Federal Reserve doesn't create what the mortgage rates are going to be. A bond that trades on Wall Street does just that. So what you need to know through this is we follow the price of the bond. So it is right there. If you squint, you can see that it's up. So what you need to understand here is this bond, or any bond, here's how it works, is the price goes up, rates or yields come down. The bigger the adjustment up, the bigger that it goes down. So conversely, the other way, if the price goes down, rates are going to go up. If you look over here from November all the way to now, you're seeing a huge rally in the market. That's why rates went from 8% to 6.7 or 6.8% where we have right now. That's a huge drop. Okay. So also why I like this website is I can go over here and really extract a lot of economic data, more than I really get from the Bloomberg report. So you can see here, month over month core inflation or CPI, headlines year over year, core jobless claims, continued claims. Here's another area, continued claims. These always get revised up. Okay, you can see right through here. Previous number on the jobless claims was 202,000, got revised up to 205. Continued claims, 1.855 million people, was revised up to 1.868. So these numbers always get revised, but it is, this number is basically staying flat. Nobody's really getting laid off, and continued claims, more people either are going back to work because this number is going down, or the participation rate has plummeted. So that's what we're looking at right there. So we're going to see rates come down just a little bit today. You might ask yourself, Dan, I love these reports, but what do you actually do for a living? I'm actually a mortgage advisor. As of next week, I'll be doing this as 34 years. It's basically, I got out of school and I just got into the mortgage business. Don't ask why, but I've been doing it ever since. So I would love to help you. I'm licensed in all 50 states, as well as Puerto Rico. I work at a federal bank. Okay, what that means to you guys is that's what gives me my licensing throughout the whole entire country, as well as Puerto Rico. But we're also one of the country's largest mortgage brokerages. What does that mean to you exactly? Well, I have up to about 60 lenders, 60 other lenders other than the bank I work for, is I can use all their products. I can use their products and their rates. So instead of you having to call all over the country and call banks and lenders and mortgage companies and everything else like that, it gets a little confusing. You have to put in your application every time. We're going to allow you to go with one application, one credit pull, and then we're going to shop your loan with over 60 different companies out there, as well as the bank that I work with. Our goal here is to ensure that you're getting the right program at the lowest rate and the lowest fee structure. So if you're already locked in, are you stuck? Well, no. What I want you to do is right through here. There's a loan estimate tab right up in that area right there. If you're already locked in and you have at least 3 weeks or more before you're closing, please load your loan estimate in there. We're going to review what you're getting from that lender with over 50 or 60 different lenders throughout the country to see if we can get you a lower rate, lower fees, maybe the above, lower rates and lower fees. Okay. But if you're out there and you're like, Dan, I would love to buy a house. I'm sick and tired of renting, but I just don't know if I qualify. Do I make enough money? Do I have the credit scores that I need? Do I have enough money as a down payment? Do I make enough money? Well, don't disqualify yourself. How many times have you thought about it and then it's like, I don't want to be disappointed and whatever. Well, let's just check, kick the tires. So how you can reach out to us to see if you would qualify, different ways. One, the Apply Now button. Click that. It's kind of unique. What you're going to do is you're going to click it and answer a few questions. It doesn't launch you automatically out to our website. We want to know a little bit about you. When are you looking to buy? What's your credit scores? How much money do you make? So when you're assigned to somebody on my staff, they're a specialist in exactly what you're looking for. Okay, but you might want to call in and maybe talk to me or email me or talk to somebody over the phone. So while you're at the rate update, just scroll down through. You're going to see a whole bunch of things, blogs, other information, mortgage calculators. At the end of this video or at the end of this website, at the bottom, you're going to see our 800 number as well as my email address. So that's it for today, guys. God bless. Thanks so much for watching. And if you haven't yet subscribed to my channel, please do, because it is right down there below. Take care. Have a fantastic day. Hope to hear from you soon.